Okay, so today's topic is the right property investment strategy for your objective. So 2.5 hours, got quite a bit of to cover. So I just, long story short, no need to talk too much introduction already. Just to introduce ourselves, my name is Emin. I'll be the main speaker for tonight's event. Hopefully you all have known me already. If not, if you're meeting for the first time, thank you and welcome. So I actually founded this company called Invest Coach. Okay, specializes in sharing investment knowledge to retail investors. I'm currently a regional investment speaker. In fact, now at home I speak more regionally. So next Monday I'll be doing a talk for people in China. And I'm also a resident trainer for the SGX Academy. Okay, so for this program, I have partnered with two real estate experts. So maybe I just get them to introduce themselves. John, you want to talk a bit about yourself? Hi, John, are you there?
Yes, I'm trying to unmute. Oh, okay. Okay, hi everyone. Great to see you this evening. So very happy to be part of this training to just help to facilitate. So I been in the real estate industry for more than 10 years since a few cycles. So hope that I can contribute whatever that I know to everyone. So today I'll just be a supporting role. So mainly will really listen and also to continue to learn from every one of you all. Thank you.
Okay, thank you so much. And of course, we have Ken. Ken, want to say hello to everybody, please?
Hi, everybody. I'm very happy to be here in this evening, Friday evening here, learning together. I mean, I always learn a lot every time I talk to Emin and John. And today, I'm like a student. I want to learn from Emin also. Yeah, good to be with everybody. Right? Enjoy.
Okay, thank you so much. Thank you so much, Ken. Okay, so of course, to begin with, we are not here to give any property tips, stock tips, or whatever tips. So purely education. So please take note of that. Please, we cannot be liable for any investment loss. In short, make money, be happy, lose money, don't scold us. Okay, this is the agenda for today. As the title suggests, we are talking about property strategies. Property strategies. So this is the agenda for today. So basically, today's segment, we are actually going to split into two main parts. Now, when we actually talk about strategy, okay, one very important point is actually this thing called objective. Okay, if let's say you don't have a clear objective, whatever plan, whatever strategy is nonsense. Okay, then you'll be just going everywhere else, anywhere else, but doing the right thing. So when we talk about strategy, we must always start with this thing called objective first. Probably we're going to spend about 20-30 minutes discussing this segment. Then what I'm actually going to do for the rest of the evening is to really share, okay, what are some of the other strategies you can consider. So I'm actually going to give you ideas of different strategies. Okay, different strategies for you to consider. Okay, answer to then question, yes, you will be actually getting the recording. Okay, so for the strategies, I just split into two main parts. One part is about, a lot of people is like to use property investment, but of course now everybody know that buy second property need to pay ABSD. So the question is, can I still invest in property and don't want to pay ABSD? So what are some alternatives you can use? Of course, all the legal means, not to find some loopholes. No, that's not what we are doing. But what are the legal means? What are the other ways to invest in property and yet don't have to pay ABSD? Okay, that's one part. I classify a lot of strategies here. Then I also classify a lot of other property investment strategies under this part called case studies. So these are some of the strategies we have proposed, we have implemented, we have seen people carry out. Okay, and of course, we just want to share. So I just want to get the expectation correct. So basically, this is a very short seminar. Usually, we actually do, like, for example, 1-day course, 2-day programs, so on and so forth. So this is the short seminar. We just want to set the expectation correct. So basically, today, what we are trying to do here is this. We just want to give you ideas. Okay, so basically a lot of things that a lot of people don't see, property can also do this, property also can do that. We just want to give you ideas. So that's why you can see we cover quite a wide array of topics. So of course, if we actually do that, give you very broad, we actually sacrifice on the depth. Okay, we may not give you the actual step-by-steps, okay, to carry out the particular ideas. So this is not really covered in today's session, so hopefully it's clear. We just want to give you different ideas, but the actual steps or the actual solutions may not be adequately covered in today's session, okay? But having said that, now, so this is what happened here. If let's say, for example, after you learn certain strategies, you want to implement, or you want to implement, or you want to try out, or discuss further to see whether it's for you. So John and Ken is actually happy to meet up with you on a one-to-one basis to help you implement. Also, this is on a complimentary basis. They're actually happy to meet up, of course, either via Zoom or really live to actually meet up. So of course, when they actually meet up, they will be in the capacity of a property agent. Okay, so if let's say certain ideas you want to explore further or see whether it's work out for you or to implement, so you can actually contact John and Ken, and really thank you for them to actually willing to offer and meet up with you one-to-one to help you implement. Okay, so hopefully this is clear. We just want to get the expectation right at the start of this evening. So for this part for my session there's a lot of discussion, okay, a lot of question and answers. Okay, so hopefully you can actually participate in all the discussions, okay, so that you actually get the most out of it. Answer to Daniel's question, yes, there will be recording. You'll be getting the recording after that. So please take note, the recording, the handouts, and the Excel spreadsheets that we actually use later will be sent to you. So I didn't actually want to send to you beforehand because it will be more meaningful. It'll be more meaningful if you actually get it, after the session. Okay. Now let's get started establishing investment objectives. So this is an exercise. So this is the exercise I want you all to do. So basically, I'm actually going to introduce you to 5 different investment objectives, as you can see here, 1, 2, 3, 4, 5. And after that, I need you to tell us what is your investment objective. Okay, I'm quite sure some of you have said that, oh, my investment objective is everything. Okay, fair enough. Yeah, I'm sure fair enough. But even if it's everything, then I need you to rank. I need you to rank which one is the most important investment objective to you. Okay, which one is the least important. Okay, so this is what's going to happen after this exercise. Okay, I'm actually going to talk about this 5. Then you got to tell me, okay, which one is the investment objective or the ranking of the investment objective. Okay, so this is a very important exercise. End of the day, I'm quite sure we all know we cannot have everything. You cannot have the best view, you cannot have the best property, you cannot have the best location and at the cheapest price. That is impossible. That's impossible. Okay, so we actually need to be very clear what is important to us, what is least important to us. Okay, so now let's get started. Okay, so basically there's 5 investment objectives, which we believe that is very comprehensive. The first one is, of course, passive income. That means you buy property, okay, with the objective that eventually, okay, you fully paid, then rented out. Then property can give you passive income stream. And of course, hopefully this passive income, more the expense, can be financially free. So this is one very common investment objective. Is that yours or not? Later you tell me. So this is one very common investment objective. Hopefully it's very clear. Buy property, rent out. Okay, property income, rental income become passive income. That's one. Okay, the second common investment objective is wealth retention. Okay, so this is more for people who want to do legacy planning. Okay, so like for example, they now that actually more and more people say that, okay, I want to pass my wealth to the next generation. Okay, I want to keep my money in property so that eventually my grandchildren still can actually see the wealth. So this is more for legacy planning. That means I just want to make sure my wealth is there, okay, it's maintained for a long period of time. So that's a very second common investment objective. Okay, the third investment objective is this thing called wealth accumulation. Okay, so there are people who actually buy property, okay, because they want a system to help them accumulate wealth. Okay, this is different from capital gain. So like, for example, later I'll give you more specific case. Like, for example, let's say you only have $200,000. So with 200,000, you can actually buy $1 million property. Okay, so with that, you actually borrow like 80% loan, correct? And after borrowing the 80% loan, every month you have to make a payment. So after fully paid the property, assuming that let's even assume that the property price will increase, your 200,000 become $1 million. So you basically set up a wealth accumulation system, okay, for you to accumulate wealth. Okay, set a system for accumulate wealth. So is that your objective? Okay, so that is the third one. The fourth one is actually quick capital gain. Okay, so that means you buy the property with the intention to hopefully flip, want to sell as soon as possible to actually make capital gain. Of course, not buy today, sell tomorrow, but you actually want to sell as soon as possible to make a quick capital gain. Is that your objective? And the fifth one is wealth diversification. So let's say, for example, I have money in stocks, I have money in bonds. Okay, I just want to put my money in different places, such that, let's say, for example, where stock don't perform, at least my property will do well. Okay, or either that, like, for example, okay, let's say most of your money actually in Singapore. I actually want to put my wealth outside of Singapore, so that, you know, just in case anything happens to Singapore, I have money outside. Okay, so I believe these are the 5 main investment objectives. Of course, if let's say there's anything that is not covered and you so believe that this investment objective, please feel free to share. Okay, please feel free to put in. So with that, I need you to let me know, okay, by typing into the chat. Okay, of course, with some very serious thinking. So try to take this exercise seriously, because it will actually affect your decision. Tell me, what is your investment objective, or if let's say there's more than one, how do they rank? Okay, so before we go to the exercise, can I just ask anybody any questions? If you'd like to, feel free to unmute yourself, or if you prefer, you can actually type onto the chat. Any questions about this exercise or the various objectives that I mentioned? Okay, Gordon, thank you so much. So Gordon, maybe you want to tell me, like, which one comes first? Is it wealth accumulation first or diversification first? Okay, if you have decided. Okay, anybody, any questions? Okay, if no questions, please take some time to think through. Okay, maybe we give you 5 to 10 minutes. Okay, for those who that put more than one, appreciate if you can help me label them, like what Alex has done. Like first wealth accumulation, second passive income, third wealth retention. Okay, or either that what Peter has done, actually put in the order. Okay, thank you so much. Also, maybe I just wait for all of you to give me your entry. Objective, interesting. Nobody actually want quick capital gain. Don't know serious or not. You're true for yourself. That means you're not there to buy quick capital gain. I'm actually very surprised. Nobody actually put quick capital gain. Be truthful to yourself. Come on, be truthful to yourself. Okay, thanks. I think all have come in already. Thank you. Okay, great. So seems like wealth accumulation is the most common one. Wealth accumulation, passive income. Okay, I think Jolene talked about wealth retention. Thank you so much. Okay, so Daniel, wealth accumulation. Okay, Ruby talked about accumulation, diversification. Thank you so much. Passive income. Okay, passive income, wealth diversification. Thank you. Okay, thank you so much. Okay, great. Okay, thank you so much. Okay, so of course, there's no right or wrong. Okay, all this is actually most suitable, but hopefully after this exercise, you have a guiding principle. You actually have a guiding principle. What is it? Okay, because end of the day, there is no perfect property. There's no property that can give you passive income, give you wealth retention, give you quick capital gain, give you wealth acquisition. No, don't have. Okay, after a while, you have to make a choice. Then how you actually make a choice is, hopefully all these objective can guide you. So don't be too greedy lah. A lot of times when you're too greedy, you get nothing. Okay, let me just go into detail what I'm trying to say here. So let's say, for example, a lot of people like to ask us this question. Should I buy a freehold or leasehold property? Now, actually, you think about it, out of the 5 objectives, only which objective you require to be freehold? Can I just trouble someone to share? Okay, let's say freehold or leasehold. Okay, only which particular objective need the property to be freehold. Actually, the rest, it doesn't matter. Thank you so much. Wealth retention, thank you so much. Okay, wealth retention, because in fact, the rest, this is, you ask me, so the only reason why you actually want a freehold property is that's why you have very clear objective. I want it for wealth retention. Okay, I want it to pass on the property for my next generation, the next generation. If not, freehold is just a good to have. Okay, hope this one got you. So if you ask me, if let's say just about wealth accumulation, just about passive income, a leasehold property can do exactly the same job. The only thing that required to be freehold is for wealth retention. Okay, so this is, hope you, now you start appreciating exercise. I hope this is clear. So of course, I know that given a choice, everybody wants freehold, but freehold also have its downside. If let's say, with the freehold, you also don't really need it for wealth retention, then why you be so bothered and accept the downside of the freehold? Okay, so hope you are getting clear on this exercise about. Okay, now loan. Alex, I answer your question later. So now for loan, okay, for which objective, then must be very particular on whether the loan or no loan or to structure loan correctly. So which particular objective will actually require this to be done very meticulously. Okay, thank you so much, Mandy. Wealth accumulation. Okay, so this is quite interesting. I have people who actually say that I want to accumulate wealth, but I don't like to take loan. I hate loan. Or either that, I want to accumulate wealth. The first moment they have money, then they go and pay up the loan already. No. If your objective is to accumulate wealth, then you have to learn how to play the loan game. Of course, later I'll give you more example of what I mean by playing the loan game. But long story short, it's basically borrow as much as you can. But of course, you have to consider the risk as well. If let's say your objective is to do wealth accumulation. So maybe I'll just answer Alex's question. So if you ask me, leasehold property value drops in after 20 years or so, may not be because now got en bloc. You actually look at the history. You actually look at history after they en bloc compared to they buy the property 20 or 30 years ago, they actually easily double. So if at least history is a guide, if you actually buy leasehold, doesn't mean that 20 years later, the value actually drop. That's not true. Okay, yeah, thank you so much. Now, new launch or resale. Okay, this is for which objective? So for which objective, we actually be very particular, should I buy new launch or resale? Okay, this one a bit tough. Anybody want to make a guess? Thank you so much, Mandy. Okay, quick capital gain. Okay, so this is the part I want to explain a bit. If I want quick capital gain, okay, by the way, if I want quick capital gain, should I buy new launch or resale? Okay, before I share the answer, maybe I ask first. If I want quick capital gain, okay, new launch, okay, new launch, why is that so? So you also have to understand a bit about the psychology about the property. Okay, let me give you this analogy here. So let's say, for example, that is a new launch property. Okay, And let's assume that all the property is the same, and all of you actually bought the property there for $1 million. Okay, so all of you actually went to buy a new launch property. Okay, all the property is the same. Then all of you pay $1 million for the property. Now, can I ask, okay, if you buy the property at $1 million, how much are you willing to sell? So let's say after you launch TOP AD, you stay in AD, okay, how much, at what price are you willing to sell? Let's say you buy at $1 million. 2 million, wow. Okay. Anybody else, please? Okay, 1.2. Okay, maybe I just get a few more. Okay, please participate in the exercise. Then you actually appreciate it better. I don't ask questions for fun. Okay, then you actually understand the psychology better. Okay, got this 1.2, 1.4. Okay, maybe I just get two more. 1.2, 1.4. Anybody else? 1.5. Okay, maybe just one more. Okay, thank you so much. Now, think of it this way. Okay, now can I ask this question? Can I ask this question? So let's say we're talking about you buy when it was, what do you call that? When you buy that time when it was, let's say, for example, still not built yet. Okay, only sales office. Okay, then after that, now you actually get the key TOP already, you stay in already. So that means that is 3 to 4 years after you buy already. Okay, now let me ask you this question. If let's say I come in, I want to buy, now TOP might be already. I want to pay 1.1 million. Anybody willing to sell to me or not? Yes or no? I want to pay 1.1. Who? Okay, will you be willing to sell to me? Yes or no? I'll pay 1.1. I only willing to pay 1.1. Anybody willing to sell to me? Yes or no? Or Mandy said yes. Thank you so much. Okay. Okay. Thank you so much. Now only Mandy's point market. I still can buy 1.1 from Mandy. Okay. So I bought the property at 1.1 million. Okay. Then after that, okay, the next person want to come in, pay 1.1. Nobody want to sell to them. Can you see? Can you see your response? So if they really want to buy, they have to pay what, 1.2. Okay. Then after that, Gordon will be willing to sell 1.2. Okay. So this can only happen for new launch. Now for resale, what is happening? Okay, for resale, what is happening? So let's say, for example, today there is a new launch selling at, let's say, 2,000 per square feet. Okay. Next to the new launch, there is an old project, 10-year-old project. Okay, selling only at 1,002 per square feet. Then you think, not bad lah. I buy at 1,002. Then the new launch 2,000. That means there's a good chance I can sell at 1,006, 1,007. Okay. But here is the issue. Let's say you buy the resale at 1,002 and all your neighbors bought at 800. Okay. All your neighbors bought 800. You bought at 1,002. Okay. If let's say, for example, is it possible that your neighbor, okay, once again, all your neighbor bought 800, you bought 1,002. Is it possible that your neighbor actually willing to sell at 1,001 per square feet? Yes or no? Okay, your neighbor bought 800. Is it possible for him or her to actually sell at 1,001? Okay, yes, thank you so much. And all you need is got people sabo. Okay, because they always refer to previous price. Then your price is stuck there. Okay, if let's say, wow, I buy 1.2, I sell 1.5, but all your neighbors are 1.2 close already. 1.1, 1,001 close already. Then how will it ever go to 1,005? Okay, so now you understand. So end of the day, I know sometimes it's quite logical to say that, wow, this new launch 2,000, that 01 is 1,005. That means there's a good chance that this 01 can be some 1,008, 1,009. Possible, but it will take time because a lot of times don't assume that everybody is like us, really go and study the property. Okay, really go and understand the pricing. Okay, there are people who's just like, okay, you know, you ask me do what I do, I also don't care. Well, I buy at 600. I buy at 600. You let me sell 800, I'm very happy already. I don't even care whether it can go 1,000, 1,200 or not. So that's why if let's say you want to have a quick capital gain, you still have to go for a new launch. Okay, I know this is a bit controversial. Okay, if you agree with me, maybe just put 1. Okay, if you disagree, maybe just put 2, or let's have a little discussion here if necessary. So if you agree, maybe just help me put 1. If you disagree, maybe just help me put 2. Of course, any questions, any comments, if you need to, please unmute yourself. Like I said, this is a discussion. Okay, thank you so much. Of course, I'm not saying that resale eventually won't get capital gain. No, of course, resale will get capital gain. So the thing I want to stress is quick capital gain. If let's say you want to buy something and you want to sell at the shortest possible time, let's say 4 years, 3 or 4 years, you had a better chance buying new launch. Resale over time, maybe 10 years, of course you can get capital gain, but you know, within 4 or 5 years, okay, the chance, not say no chance, but compared to new launch has better chances. Okay, thank you so much. Okay, now rentability. So which objective is very important for rentability? You have to make sure that property can rent out. Which objective is the most important? So just now we actually talked about this 5 objective. Thank you so much. Passive income. So please, this one is a very common thing that you know, you can ask John about. We actually see like for example, when we actually have a client saying that, oh, I want to buy a property for rental. Okay, this is for my passive income. Then we tell them rental very straightforward. You have to go for catchment area. Rental catchment area, District 1, District 3, District 9. Okay, then they'll start saying things like, I don't have the budget, but I want 2 bedroom, blah, blah, blah. Can I actually buy something at District 19? Can I actually buy something at Sembawang cheaper? Then there is an issue already. See what I'm trying to get at? So if let's say it's for rental, we have to face it now. So basically, if it's for passive income, we have to face it. I would rather you buy, let's say, like a studio 1-bedder in District 9, okay, than having a 2-bedder or 3-bedder in what you call that, in Yishun or Sembawang. Okay, hope that is clear. So if you want passive income, that's your main objective. Go for a small one without budget. Okay, that's it. Be very clear about it. Okay, size, I think nothing much wealth accumulation. Now, property in Singapore and overseas location, which objective is the most important? Okay, should I have the property in Singapore, overseas, and very particular about location? So which objective is actually most important? Okay, maybe I just share again what objective? Okay, thank you so much. Wealth diversification. Wealth diversification. So a lot of people actually didn't consider this. A lot of people actually didn't consider this. Okay, like for example, actually, if you ask me to buy overseas properties, okay, the most the most logical reason is actually for wealth diversification. If you actually talk about capital gain, and so on and so forth, actually Singapore properties is actually very good. Still have capital gain compared to, you know, like let's say KL, Bangkok. If you ask me, Singapore, the capital potential gain is actually higher. Okay, so if you ask me, the most probable reason for doing overseas is actually wealth diversification, which a lot of Singaporeans overlook. If let's say you are a Singaporean, you have a Singapore property, very likely 90% of your money is actually in Singapore. Okay, of course, I'm not saying that anything will happen to Singapore, but you also cannot guarantee. What if one day Singapore like Hong Kong? I'm quite sure you all know what happened to Hong Kong. By the way, the issue with Hong Kong never end yet. So if you can afford, does it make sense for you to do some wealth diversification? So let's say if you're thinking about a second property, you already not worried about wealth accumulation, you're really not worried about passive income, you're not worried about capital gain, then why don't you, take on this objective of wealth diversification? That's what we are trying to say here. Then the other consideration is this, this is for those who have multiple property. Let's say I have 3 properties in Singapore, okay? Then maybe you should consider having at 3 different locations instead of everything in CBD or everything in the west side, okay? You may actually want to consider one in CBD, one in the west, one in east, so on and so forth. Okay, so hopefully it's clear. So thank you so much for participating in this exercise. Hopefully you are clear about your objective. Okay, like I said, end of the day, there's 101 strategies out there. Everything is good, everything is nice, but unfortunately we cannot have everything now. So objective is something that is actually going to guide us in this exercise on which strategies to choose best. Okay, there's a question from Ying Xiu. Some people say studio is harder to sell and better for rental. Is it true or not? Okay, so maybe later John can help me. Okay, so of course it also depends on demand and supply at certain point in time, which particular project. Okay, so you have to understand this. End of the day, a property is not exactly a commodity. Okay, what do I mean by that? Like for example, if let's say today you go and buy a DBS share, tomorrow I go and buy a DBS share. The DBS share you have is exactly the same as the DBS share I have. So if we want, we can exchange, also not a problem. Okay, so that means if the exactly same is a commodity. But if you talk about property, is different. So where is your studio? Is your studio in CBD or your studio in what do you call that, in Sembawang? So of course the one in CBD, if you ask me, still easy to sell, and of course still easy for rental. Okay, so I don't really agree with that statement. But of course, the point I'm trying to stress across is the actual property is very important. So I don't think it's actually harder to sell. Okay, John and Ken, do you have anything point to add on Ling Xiu's question? Do you all like to comment or anything?
Okay, I just like to add a little bit. Okay, so it depends on your strategy again. Let's say you are buying something just for passive income. You don't need to resell it, right? Then of course, let's say a studio, not too bad. Okay, you can keep collecting rental, and rental may not be so difficult because the entry price for tenant is quite low, right? But of course, if you buy a studio, wanting to make big capital gains, and you buy in the mass market area, maybe like what Emin said, maybe Sembawang, Yishun area, and whereby majority are upgraders, then you might have a difficult time. So I think I agree with what Emin said. So before you invest, do think of what is your strategy first. Does this strategy or what you're looking for fits in when you buy the property itself? Also, a lot of time we do the opposite. A lot of time is that we go to showroom, or we thought that this is the top selling property, then we go and buy, but it may not suit your objective, you see. So it shouldn't be the other round. It should suit know your objective first, then the correct solutions comes in. That's my point. Yeah.
Okay, thank you so much. Maybe I can give you some precise example. John, don't mind help me. With the Tampines, at time you look at the show flat, what is it called? Tampines.
Treasure.
No, the very big one. Is it?
Yeah.
Treasure. Is it
Treasure.
Treasure, correct.
Yeah.
Treasure. Okay, so Treasure they also have. So what happened here is this. Of course, pre-COVID, we went to the lot of show flat. We went to the Tampines one Treasure, and we also see one at next to Plaza Sing.
House on Handy.
Correct, House on Handy. So if you ask me, okay, Tampines Treasure, if you want to buy a studio there, I personally wouldn't be so confident. You think about it, you know, what is the catchment? Okay, who would actually want to rent a studio in Tampines? Cannot say don't have, but in terms of catchment, a lot lesser. Okay, but House of Handy, okay, if let's say studio, I'm very confident. Okay, you can rent out to students. Okay, a lot of Indonesian students, they're very rich. You can rent out to people working in the CBD area. You want to sell, no problem, because it's in District 9. When foreigners want to invest, okay, they don't mind buying from you. So studio, no problem. So hope you see what we are trying to get at now. So where is the studio also very important. Okay, say thank you so much. Any other questions before I move on? Hopefully you find this exercise interesting, useful. Okay, I just wait for maybe 2 to 3 minutes. If no other questions, then I move on. Okay, great. Ken, is Jasmine in already? Oh,
I don't think so.
okay. But you text her already, right?
Yeah, but maybe
Okay.
he got something on.
Yeah, then no choice. Anyway, it's recorded. Then I can just pass her the recording.
Okay.
Thank you so much. What is the main risk of property investment? So of course, you're talking about the price drop. Okay, if you ask me, especially for now, the main risk that you buy the wrong property, then the price drop, you cannot rent out. Okay, then loans, you cannot measure loan interest rate risks. Yeah, so these are some of the risks that you have to take note of. Okay, so basically, once again, if you ask me, is the property price, are you buying the right price? Okay, the loan, can you manage the loan? If it's for rental, can be rented out. So these are, of course, the 3 main risks that we have to look at. Okay, I move on. So having the objective in place, and now for the next 2 hours, or in fact 1 hour 45 minutes, I will actually give you a buffet of different property strategies. I'm actually going to share with you a buffet. So as I mentioned just now, my job today is to actually give you ideas. Okay, then after that, you can ask yourself, hey, does any of these strategies suits you or not? Okay, then of course, if you're interested, then you can talk to John and Ken, and let's say you are keen to implement. So once again, like I said, today, I may not give you adequate information for you to implement. I want to be very clear here. Okay, now, so I actually classify a group of strategies under alternative to paying ABSD. So a lot of people actually want to buy the second property. But then, of course, we all know buy second property, you have to pay ABSD. So these are actually, there are a total of 6 ways, as you can see here. 6 ways to avoid paying ABSD. And of course, if let's say anybody asks me, is it worthwhile to pay ABSD? I can, my first instinct will be tell you, no, it doesn't make sense. 12%, it doesn't make sense. Of course, under certain very specific scenario, maybe it's actually still makes sense to pay ABSD. But if not, I will actually tell you no. Okay, so one situation I think it's okay to pay ABSD is this. Let's say that particular project, okay, most of the buyers are foreigners. Okay, most of the buyers are foreigners. So let's say you pay ABSD, and after that, because foreign they buy, obviously to pay, in fact, they pay more than you. Okay, then net, you are still buying it cheaper. Then it's fine. Okay, that is fine. Because next time when you sell, okay, your cost price is actually cheaper. Okay, but under normal situation, let's say, for example, people buy 1 million, then you have to pay 1.12 million. Okay, then your cost price is more expensive. Okay, if you ask me, that is probably one of the only situation that I think is worthwhile to pay ABSD. If not, okay, I think that it doesn't make sense, and we should try to prevent paying ABSD by doing, one of these strategies. If let's say you still want to invest in properties. Okay, let's go by one. Okay, number one is decoupling. So of course, I think this is quite common. So please take note, decoupling can only happen for private properties now. You cannot do decoupling for HDB. Okay, decoupling can only happen for private properties. So let's say you and your wife or your husband own a property. Okay, we take one name out. Then after that, the one person own the current property, the other person go and buy the other one. The only point we want to stress across here is this, please, decoupling is not a straightforward process. Please think through, please do the calculation. I would really suggest work with experts like John on Ken, who really sit down with you, go through the nitty-gritties of decoupling first before you go and execute. Okay, so there are a lot of things that, you know, decoupling sounds good, but in the end, execute then got problem. Okay, like for example, number one, who to buy which one? Whose name to take up? Okay, so that one cannot anyhow. Like for example, if let's say, you know, husband earn more or the wife earn more, okay, which ones should still remain in the property, which ones to take out? So that one needs certain loan consideration. You have to see whether, you know, let's say one person name, can it actually still shoulder the current loan, and the name take up, can they actually can he or she borrow the next loan or not? So that one is one consideration. Okay, next, you take name out, there is this stamp duty component. So let's say, for example, this property now is 50-50. If you take one name out, okay, legally speaking, the remaining party is buying the share from the exiting party. So there is also a cost involved. There's also a cost involved. Okay, so it depends on how big your property is and how big your next property is. So it can be a case whereby, after considering this stamp duty, okay, after considering stamp duty, it's not worth for myself, I'm going to pay ABSD. Okay, please take note. Okay, long story short, decoupling, there is a cost involved. Doesn't mean it's free. Okay, so on this juncture, that's why, okay, let's say, for example, if you have the intention of eventually going to buy a second property. So let's say, for example, now you're on HDB, you want to upgrade, and you have the intention that eventually you want to buy two properties, you may actually want to start planning now. Okay, what you can do here is this. One very common strategy is actually called 99-1, whereby when you actually buy the next property, okay, one party own 99%, the other party only own 1%. So that when there is a buyout, okay, the stamp duty is only on that 1%. Okay, so for those who intend to buy two, it may make sense for you to plan ahead. 99-1, that's what it's being called. Okay, so this is the one that a lot of people don't talk about it because it's actually very sensitive. So in fact, me and John, we come across a real case. This couple actually own one property, want to buy another one, decouple. So basically is the husband name got taken out, then the current property stay with the wife. And unfortunately, after decoupling, they actually went through a divorce. Okay, so technically speaking, the husband lost everything. Okay, so such things can happen. Then the other one is happened to my friend. So same thing, they actually did a decoupling. Then the wife's name got taken out, husband name remained. Then the wife become very sensitive. Okay, she's actually not very comfortable. It's like she felt insecure. Okay, there was certain insecurity. So end up, you know, because of making more money, they they were how should I put it? They weren't in very good relationship because of their insecurity. So these are the things you also may need to consider. There's no point for the sake of making money then get into this kind of trouble. Or bankruptcy, the same thing. So this is the case whereby after decouple, okay, then let's say the remaining party bankrupt, then again same thing, all gone. So something to consider when we actually do decoupling. And of course, if you actually buy two property, right, your installment increase significantly. I used to have one loan, 2% share, now it's one loan each. Can you really manage or not? So that is something that you have to consider as well. Okay, so this is for decoupling. Anybody, any questions, comments? Okay, if you like to, please unmute yourself. Anything? In that case, maybe I just ask here, anybody would actually be considering decoupling? If yes, maybe help me put a 1. If no, please help me put a 0. Okay, for now or for later, doesn't mean have to be now. Okay, later means can be 5 years later, 10 years later. Okay, anybody who actually want to consider this? Okay, if yes, put a 1. If no, put a 0. Okay, so Gloria, so take note. So these are the things to pay attention to. Thank you so much, Gloria. Okay, thank you so much, Ruby. Yes, so for those who actually want to consider, so these are things would really suggest like you talk to people like John who really go through all the numbers, okay, before you plan. Even if let's say you are upgrading to the first property, okay, there's something you can prepare first, like I said just now, 99.1. So those who actually put 1, even now that you're talking about buying the first property first, okay, you should consider. You should actually start the planning. Okay, thank you so much. Now, next thing is actually this thing called the dual key. So this one, understand that some of you may actually don't know about it. Or maybe I just ask here, if let's say this is the first time you heard about dual key, never heard before, don't mind, please help me type a A. If you heard about dual key before, please help me type a B. Okay, never hear before, help me type a A. Heard before, help me type a B. Okay, thank you so much. Okay, so luckily we actually talked about this. Okay, yes. Okay, so more for those who actually heard before, there's actually this kind of property called dual key property. Dual key property. Okay, so this is what happened when you actually enter into your main door. There is actually 2 other doors. One door here, one door here. So this is considered one unit. This is one unit. Got one title, one property title. Everything is one. So in fact, like for example, even like electricity, gas, also one unit. So this is one. So you actually enter here. There's one door to this place, another door to actually this place. Okay. So of course, what a lot of people does here is this. So after they buy here, they actually stay here. This part they actually rent out. It's actually one property, but they can use it for investment. This is what we call a dual key unit. Okay, so of course the supply, relatively speaking, is limited, but if you want, still can find. Also, this is one option for those who actually want to consider really buy a property and with some investment buy a property and with some investment income. Also, basically your studio you can rent out. The good thing is that you want to collect rental very easy. The bad thing is that maybe let's say your tenant party then got problem. So this is also one real case. We have one client. Okay, they actually of course do this. Then after that, the tenant is a very beautiful lady. Very beautiful lady. Then the wife is not very happy with the husband. So these are the things, if let's say your tenant also get too close, also got issues. Okay, but yes, you can consider this. So hopefully I shared something, especially with type A. This is one thing you can consider. Then you wouldn't have to pay ABSD. Okay, now the other thing you have to take note here is this. As I mentioned just now, the utilities is also under one account. You cannot split utility. That's a problem. You cannot split utility. So basically the aircon, the water, I don't think they have gas. Okay, aircon, water, electricity, it's all combined bill. So when you're doing the rental contract, you need actually a very good agent again to make sure that all these issues are clearly spelled out. How do we actually manage all these issues? So things like this, you cannot just use a very standard contract. So that is something to take note. Okay, thank you so much. If there's any question, do give a shout out. Anyone, any question, do give a shout out. If not, I just move on because I think this is actually quite straightforward. Okay, I want to spend some time here to talk about overseas properties. I think probably a more interesting way is to share my own personal experience. So all these photos are taken by myself. Pre-COVID, I actually went down to look at some Bangkok properties. Of course, with the intention to actually invest, but of course, before I can do anything, COVID happens. Then yeah, in the end I didn't go through lah. In the end, I actually didn't go through. But I actually do have the intention to actually buy something at Bangkok. Okay, now maybe I just want to share my thinking process. Then hopefully also it can give you some ideas, which is what today's seminar is about. Now, why do I actually want to consider overseas? Okay, because it actually have helped me to achieve this particular objective, wealth diversification. Wealth diversification. Okay, like for example, of course, for those who know me, you know that I am actually have different wealth accumulation systems. Okay, I have different wealth accumulation systems. So to me, every of my investment have a particular objective. Okay, like for example, passive income. Okay, I actually use my REITs. Okay, my margin on REITs. Also, eventually, I'm actually going to build a REITs portfolio to give me passive income. So this objective settled. Okay, wealth retention. Frankly, I am not so bothered. I belong to one of those whereby my children should take care of themselves. I will, if she's lucky enough, she can just take over whatever from me, but I'm not going to pay special attention on this. Okay, so this is not really my objective. Okay, wealth accumulation, I have a different system here. Like for example, I have my stocks portfolio, I have my current property. Okay, my current property, I have like my unit trust. Okay, so on and so forth. I use different stock instrument, of course, and my current property for wealth accumulation. Okay, quick capital gain, I'm into stocks. So of course, again, this one I didn't really go for it. So to me, I'm not those who go for quick gain. The only objective that I realize my current investment is not helping to achieve is wealth diversification. Okay, so I calculated like for myself, easily 90% of my money is all in Singapore. 90% of my investment is all in Singapore. So if anything happen in Singapore, okay, then I'll be in trouble. And we are talking about, let's say today I'm 46 years old. If I'm lucky enough, I got another 50 years to live. I mean, 50 years, anything can happen. You cannot be so sure that 50 years Singapore is still as what do you call that? Still as good as now. Of course, I wish it's going to happen as good now. So if let's say I can afford, it does make sense to invest in properties. Of course, Mandy, yes. Of course, if you invest in property shares, it's diversification, yes. So that's my thinking process. So again, hopefully it's clear because I realized a lot of people ask them, why you buy overseas for capital gain? Not really. After all the costs, things like that, yes, there are some capital gain, but it may not be as good as in Singapore. Okay, Some really actually make capital gain from what we call developing nations, like Cambodia, like Myanmar, but it's super high risk, super high risk. So if you think in terms of risk adjusted, hey, the capital gain may not be so exciting, in my opinion. Okay, so why Thailand? I just want to share. So if you actually want to do overseas, it's actually good to do this thing called the top-down approach. Top-down approach. We have actually done all these tabletop exercise to actually see which country will be suitable for you. There's no best country, which one is most suitable. So personally, the way I do it is I actually rank all the different countries in this few variables, 1, 2, 3, 4, 5, 6, 6 variables, and see which one score the highest. So basically, to me, what is the one with the highest score is actually Thailand and Malaysia. Thailand and Malaysia actually the highest score. And what is most important to me is, like, for example, lower quantum. Okay, I don't have a lot of money, contrary to what a lot of people think. Definitely John is a lot richer than me. I'm actually very poor. Okay. So I need lower quantum. So Thailand, like for example, the property I'm actually looking at is about 100,000 Sing, 200,000 Sing. Okay. So basically you can buy a property with about, 80,000, 100,000, you can really buy a property. So this is something very interesting to me. I also need like local support. Basically, the agency there can be trusted. The end of the day, after you buy, you cannot be there, right? That means the agency there, there's a proper system for the property management to manage your property. So that's why I mean that local support. Okay, rental yield is actually quite straightforward, right? You actually rent the property, then versus your purchase price. That's rental yield. So rental yield, Thailand, not too bad. Okay, the other thing is this thing called the rental spread. Rental spread. Now, please take note, if you actually buy a property overseas, you have to borrow in that country. Okay, don't think that I can borrow in Singapore and after that, based on Singapore interest rate, go and buy a property there. No. Okay, so I know that even like, let's say, for example, I go Thailand, I go UOB, I won't be getting the Singapore property loan rate, which is about 1+%. No, that won't happen. Okay, so a rental spread will happen when the rental yield minus the interest is positive. That is what we call the rental spread. Okay, once again, what's the rental spread? Rental yield, okay, minus the interest, there's a rental spread. Then with the rental spread, then you can actually make some money. If let's say the rental spread is negative, very likely that you still have to top up because your interest rate is so much higher than your rental. Then you have to, every month after buy, you have to top up. Okay, the last one I actually used to grade all this is based on the property rights. Property rights. Okay, certain company, a certain country you buy already, you don't really own the properties. You realize, like for example, Vietnam, China, Cambodia. Anybody want to make a guess? How come? How come this country you don't really own the rights? So what is something unique about Cambodia, China, Vietnam? Anybody want to make a guess? Anybody want to make a guess? Cambodia, China, Vietnam. How come you don't really have that property right? Okay, thank you so much. Okay, generally speaking, they actually still, thank you so much, Mandy. They still have the communist law, whereby basically, even their individuals don't really own the property. Like for example, in China, there's no such thing as freehold. And of course, as a foreigner, it's even more difficult to own. So let's say when you actually buy property in these places, in fact, Thailand included, you realize that the contract is structured in a very funny manner. Okay, it doesn't say that you own the property. You just own the rights to use or something like that. You don't really own the property. So that is something to take note of. So this is how I actually rank. So as I mentioned, for those who actually want to do overseas, good that you actually do all this exercise. Don't just because you attend a seminar, then just go to that country to buy. Okay, do a top overview first and really ask yourself which one is more important to you. Like for example, for me, okay, I want less headache. So basically, I want lower quantum. So there's been lower quantum local support to me is the most important. Okay, if you want really zero headache, or in fact the least headache, like for example Australia, then you have the property rights to help to support you. Okay, and for those who actually want highest gain, you can try like Cambodia and Vietnam. Okay, Cambodia and Vietnam. Okay, I think probably these are the two places that you can probably achieve higher capital gain. But then you have very high risk. Okay, you don't have local support, you don't have property rights. Okay, so anyway, this is how I select Thailand. And of course, you have to do risk management. Okay, you have to do risk management. Like for example, in my case, the worst case scenario is that I actually take it as like my holiday home. Okay, personally, me and my wife, we actually like Thailand very much. We keep thinking that, or maybe next time when we retire, we can actually go there and stay for 3 months, then it can become my holiday home. So these are the risk management. Okay, so this was my thinking process, how I choose Thailand. Hopefully, just this story to make this session more interesting. Okay, and the main point I want to stay here is this: if let's say if you want to have a second property, don't have to be so fixated that have to be in Singapore. Really ask yourself, okay, what is the objective of the second property? Okay, if you already have enough money, you have wealth accumulation, your passive income, okay, why don't you consider achieving the objective of wealth diversification? Then an overseas property may actually make sense to you. Okay, so this is what I would say about overseas property. Anybody, any questions? Anyone, any questions about overseas properties? If not, maybe I can just ask a quick question. Okay, of course not now. Who thinks that they will either now or in the future consider overseas property? If yes, don't mind, help me put a 1. If you think that no, you will never buy the overseas property, please help me put a 0. Okay, thank you so much, Dan. Thank you so much. So hopefully this thinking process is interesting to you. Okay, of course, like I said, for those who actually want to go through this exercise, maybe you can kind of speak to us. We can actually guide you into deciding how to do this exercise. So end of the day, my point is overseas property, you cannot just attend one seminar, then after that just buy from the seminar. No, don't do that. Don't do that. A lot of people do that. Just go to a seminar and buy. There was one time we actually met this client, bought something in Australia. Then me and John asked him, what is the exact location? He can't even say out. And then we asked him, what is the exit strategy? He's like, what do you mean by exit strategy? Okay, so of course have to be well thought out. Okay. Okay, if no questions, I move on. Okay, next is commercial properties. So if let's say in Singapore, you want to buy property in Singapore, you don't pay ABSD, you also can buy commercial property. Okay, so that is other option. You not necessarily have to buy, let's say it's for rental, not necessarily have to buy a residential property for rental. Okay, but please take note, there is actually this saying, residential property can always be rented out or sold. It's only a function of price. At first, I don't believe this statement. Okay, what happened is this, every year I have to go and pay respect to my grandparents. So my grandfather is actually buried in Bukit Brown Cemetery. And we go in by Sime Road. Of course, now it's a bit changed. So in the past, we actually go in by Sime Road. So for those who actually know that place, Sime Road, okay, I think it's Island Golf Course or something like that. So just at the entrance of the Sime Road, there are actually a row of semi-D, I think. It was semi-D. So few years ago, I think easily 10 plus years ago, we drive there, we saw people constructing semi-D there. So I was like, crazy, who actually want to stay there? Okay, you practically have graveyard at your backyard, no? You practically have, it's not that the grave is like 50 meters away, no, you have the grave at the backyard. Who will actually want to stay there? But to my surprise, now that place, not only people are staying there, and now sell a very high price. Okay, so to me, I totally agree with this statement. Residential property can always be rented out, can always be sold. It's only a function of price. It's always about cheap or expensive. 1 million cannot sell 800,000, 800,000 cannot sell 600,000. There will be a price that it will be sold. Okay, but for commercial property, once you get the wrong one, free, let people, give people free, people also don't want. Okay, so for those who actually want to consider commercial property, always remember this, the wrong commercial property, you let people rent for free, people also don't want. Okay, a very classic example is actually this place called, yeah, just slip my mind. Okay, someone can help me. Next to Alexandra IKEA, there's this hotel, what is it called? Anyone can help me here?
Yeah, you mean Alexandra Central?
Thank you so much. Yes, Alexandra Central. Okay, so for information, Alexandra Central is the hotel next to Alexandra IKEA. They have a commercial block. Okay, if I remember correctly, they actually strata sell the commercial units. Okay, and again, of course, I may be wrong. Okay, if I remember wrongly, but the first floor unit selling at about 7,000 PSF. 7,000 per square foot. Okay, and you go there, you know, today you can see a lot of empty shop lots down there. Once that place, okay, this is about commercial property. It's like once that place don't get warm up, people don't go there. People don't go there, then no people want to rent there already. Okay, it's a very interesting chicken and egg thing. So you really need all the shops to be up. Then people go there, then there's a continued life. But somehow if you cannot get it up, then people don't go there. Then it's very hard to get it up. Okay, so hopefully you all get my point here. Commercial property is not for everyone. So long story short, it's only for professionals who really know what they are doing, okay, who are very clear. If you are someone who just like, never mind lah, by the way, you just go and Google a bit, hey, this one not bad, go and buy, please don't go into commercial property. Okay, please don't go. If you want to go, then you must really be prepared, do all the analysis, understand what you're doing, so on and so forth. Okay, the other case example I want to share is like, for example, there's one period, people actually go and buy industrial properties and rent out as rent out to tuition agency, rent out to people running offices. So some of them may be against the law, for information. So industrial properties, they have very strict laws, like for example, how many percent of the property have to be for industrial use, only how many percent can be for office use. So if you don't know, you just buy the rent out, you can be committing a crime, for information. And you cannot go and say something, I don't know. Some of these crimes have to go to jail. So hope it's clear. Commercial property, yes, it's an alternative, okay, but it's for someone, I would say it's for professional, or either that someone is willing to do an analysis. If you just want to do hassle-free, sorry, commercial property is not for you. Hopefully that's clear. And if you really want commercial properties, I will urge you to have this concept called margin on REITs. Okay, I think this one will get a lot of y'all quite interested. Okay, margin on REITs. Okay, if you ask me, in fact, this is what I do. Okay, to be very frank, I only have one property. And to me, this is my second property. Of course, I practice this, and this is my second property. I avoid all the ABSD. I am investing in commercial property. I'm investing in overseas property. And yes, like I said, to me, this is my second property investment. Okay, this is going to be a long one. I'm probably going to spend easily 30 minutes on this point. So what I suggest here is this. Anybody has any questions? So again, just let me be very clear. I'm not here to give you all the necessary information to start doing this margin on REITs. I just want to give you some ideas, something you can do. Okay, instead of buying a second property, you do this. Okay, so that you avoid EBSD and you get the benefits of overseas property, you get the benefits of commercial property, something you can do. Okay, if you really in the end want to implement, unfortunately, maybe today the information may not be very sufficient. Of course, if you're interested, you can join some of my courses outside that really specialize on margin on REITs, or at least understand the risk first, okay, before you proceed. So hopefully we have the understanding on that. Okay. So what is why use margin on REITs? Okay, today I want to talk about the main risk, which is margin call. And of course, we talk a bit about how to manage margin call. Okay, and then additional risk to take note of. Okay, in the first place, what is a REIT? A vehicle structured for investors to pool their capital for investment into large-scale income-producing properties. Okay, I'm actually not going to go into detail of REITs. Long story short, buying REITs, you are buying properties. Okay, REITs is of course listed in SGX. Is what do you call it? Securitized instrument. Okay. Basically, if I buy REITs, I am joining a lot of people together to actually go and own properties. Can I actually have a sense here? If let's say you never heard of REITs before, please help me put a 0. If you already know what is REIT, please help me put a 1. Okay, can I just trouble you? That's me a sense. You never heard of REITs before, please help me put a 0. Okay, good. Okay, great. So all have roughly know what is a REIT. Now, I'm actually not going to detail, but long story short, you're actually buying properties. I want to focus on this thing called margin, margin on REITs. Now, okay, you can actually open this thing called a margin account with certain brokers. Like for example, my margin account is actually with Kim Eng. You can also have margin account with, like for example, Philip Capital. These are the two main ones. Okay, going forward, okay, more and more brokerage account, you can achieve margin account. Now, what is a margin account? Basically, you are borrowing money to buy stocks. That's what it do for you. Okay, you are borrowing money to buy stocks. So like for example, today margin account give about 3.5 times leverage. What does it mean here? If I put in $10,000, I can buy up to 35. How I get 35,000? 3.5 times 10,000. So basically, this is what happened. I put in 10,000. I am technically borrowing 25,000 to buy stocks. 25,000 to buy stocks. Okay. The current interest rate, which is a floating rate, just like property is a floating rate, current is about 2.8%. So it do changes. And of course, cannot expect property loan rate. Property loan rate is the lowest. For this one, it's actually 2.8%. Okay. Annual, yes, it's annual. Okay. Annual calculated on a daily basis. Now, how the account works, so if I say you are interested, of course, you start the account. This is what you do. You have to go and deposit $10,000 first. So this what happened. You open this account, margin account, you put in $10,000. So now, let me ask you this question. So basically, After you put in $10,000, you go and buy 5 stock, $2,000 each. Okay. Did you actually borrow any money from them or not? Yes or no? You put in $10,000. After that, you go and buy 5 stocks, $2,000 each. Did you actually borrow any money from them? Yes or no? Okay, no. So this is what happened. No. I open the account, I put 10,000. I go and buy stocks, $2,000 each. First time I buy 2,000, next time I buy 2,000. In fact, I'm still using my 10,000, never touch it. Okay, but this account very special. After I use up my 10,000, I can still keep buying. Okay, I can still keep buying, and I buy up to 3.5 times. So basically, I can buy up to 35,000 worth of stock by depositing 10,000. Okay, so please take note, for the first 10,000 or the first 5 stock, let's assume every stock is 2,000. For the first 5 stock I buy, I use my own money, so obviously there's no interest. There's actually no interest. Okay, only when I start borrowing, then the interest will come in. Okay, then the interest will come in. Okay, now how the interest work is this? The interest charge, they will just add to your borrowing costs. Okay, they'll just add into your borrowing amount, so that it's not like every month you need to top up. No. Okay, they'll just add into a borrowing amount. At the same time, the dividends, of course, let's say I buy REITs, the dividend come in, they'll just deduct from the borrowing amount. Okay, so as such, there is no outlay required. So you just put in a 10,000, that's it. Then when it's operational, you actually don't receive any cash from dividend. You don't have to put in any more cash into this account. Okay, now up to this juncture, any questions? Anybody, any questions? That's how it actually works. If you like, you can actually unmute yourself. It's not installment payment. I put in 10,000. Only interest, correct? Yes, you only pay interest. There's no installment. I put in 10,000. Okay, if I buy 20,000 worth of stock, there's actually interest charge on that 20,000. Okay, then the interest will add on to my borrowing amount. Okay, so there isn't a concept of, okay, I have to keep paying interest or take money out. Okay, so legally speaking, the stock is owned by the broker. Okay, so the stock won't be in your CDP. The stock cannot be your CDP. The stock will be owned by a broker. Okay, any other questions about this, how it works? So it's a bit different from property. You actually borrow the money up front, then after you pay down. No. This one is you put in a deposit, you are allowed to buy more than you deposit, then any borrowing will just incur borrowing costs. Okay, there is no installment schedule here. Okay, great. Now, why is this interesting? So let's say, for example, I just do what I call a plain vanilla REITs. Let's say I buy this REIT, give me 6% dividend yield, for example. Okay, I buy REITs, give me 6% dividend yield. So I buy 10,000, of course, my dividend yield is 6%. So let's say I use this account, I buy 10,000. Technically speaking, I actually borrow 25,000, assuming I borrow to the max. I can borrow up to 25,000, I borrow to the max. Okay, I actually use 3.5% here for this illustration, but now interest is 2.8%. Okay, like I said, the interest do fluctuate. So for the purpose of this calculation, I use 3.5%. Okay, so when I dividend, my 6% is not based on 10,000. My 6% is actually based on 35,000. So I actually get $2,100 worth of dividend. I need to pay interest, and my interest is only based on 25, not 35, because I only borrow 25,000. So my interest is actually 875. My dividend minus interest, I actually get 1,225. So can you see if I do a margin on REITs, my dividend yield actually increase from 6% to 12.25%. Why? Because I put 10,000. If I don't margin, I only get 6%. But once I margin, my outlay also still 10,000, but my dividend yield increased from to 12.25%. And why? Because my dividend actually become 1,225. Okay, so that is the beauty of margin. Yes, correct. Arvin, you are correct. It's a bit like the interest only loan. That's why I said it's actually quite similar to buying second property. Okay, don't say awesome first. I will talk about all, now I only talk about all the good things. The bad things will come. Okay, trust me. I'm quite sure you know me well enough. I will talk about the bad things. Okay, great. Any other questions? Anybody have any questions or confused already at this point? Anything to ask? Okay, if not, I push on. Now, why to me, okay, this is like, in my case, why I see this, I mean buying a second property. So this is exactly, if you want, can see it like a buying property for rental. Okay, let's look at the left panel first. Let's look at the left panel first. So assuming we buy a property of $1 million. Okay, just for apple-to-apple comparison. Okay, of course, property can borrow more, but for apple-to-apple comparison, let's say we actually borrow only 650,000. We borrow 65%. Okay, we can borrow up to we can actually borrow up to what do you call that, 75%. But of course, let's say you just borrow 65%. Okay, so that can be apple-to-apple comparison. You borrow for 30 years, interest rate is 2%. Okay, your monthly payment work out to be about 2,004. Okay, your rental yield is actually 3%. Okay, so let's say rental is 3%. Your rental per month is 2,005. So this is what happened. Let's assume that your property price don't change. Assume that property price don't change. Okay, and basically your monthly installment is 2,004, as you can see here. And your rental is 2,005. So your rental can cover your interest payment. Can you see? So you need to top up. So what's going to happen here is this: 30 years later, the whole property is yours. You just put in 35,000. You rent out the property. The rental cover interest, so you don't get anything. As soon as you don't pay up, 30 years later, this property is yours. Okay, so the REITs is actually quite similar. So same thing. I put in $35,000. I can go and buy $1 million worth of REITs. Okay, and after that, I have to pay an interest of 3.5%. At the same time, I get a dividend yield of 6%. Okay, I get a dividend yield of actually 6%. Okay, I didn't actually do the precise calculation here, but basically, again, same concept, assuming the price don't change. Okay, after I put at 35,000, the interest will be paid by dividend. Interest will be paid by dividend, and any excess dividend, there'll be excess dividend. My dividend is only 6%, interest rate 2%. Any excess dividend will be used to pay down my loan amount. Okay, will be used to pay down the loan amount. Okay, and it will just take me 13.7 years for me to pay off this $1 million. Okay, so anyway, the main point I want to stress across is this. Okay, if I do this thing called margin on REITs, it can be exactly very similar to buying a property for rental. Okay, Ruby has a question. What do you mean by 35,000? Ruby, can you actually explain a bit more? So basically, both you have to put in 35,000. Okay, for both, you buy 1 million property, 1 million REITs, you have to put in 35,000, your investment. Okay, then you borrow 65,000. So sorry, 650,000. Okay, what about 350,000? You want to elaborate a bit more? So 350,000 is your initial investment. Okay, so anyway, my point here is this. I just want to highlight the similarity. Okay. Thank you so much. Sorry. It's actually 350,000. You're right. Okay, thank you so much. Thanks for pointing out. Okay, so anyway, the main point I highlight here is this is actually very similar. Buying this, doing this is very similar to buying a second property for rental, and rental pay off the installment. Okay, if you understand what I'm trying to get at or if you understand what I'm talking about for the past 5 minutes, don't mind just help me put a 1 onto the chat, please. Thank you so much. Thanks. Great. Of course, any question, please ask. Okay, Daniel has a question. Correct. Thank you so much, Daniel. You're correct. So after 13.7 years, yes, I own the REITs, and they are no longer a margin. Because you think about it, my interest is actually 3.5% on this 650,000. Okay, my dividend yield is 6% on this 1 million. So basically, I would have more dividend than my interest. Okay, and the additional portion can help me to pay off the loan, and it will take 13.7 years to do so. Okay, okay, to be very frank, I only started this like 2-3 years ago. The highest I hit was 3.5%. Okay, the highest hit to me was 3.5. Now it's one of the okay, now it's not the lowest, in fact. So when I first started was I think about 2.5. So now I'm doing at 2.8. I think if I remember correct, the lowest was about 2.3. Okay, but that is over the past 3 years. That's over the past 3 years. Please take note, this interest rate is determined by the broker house. Okay, this interest is this interest rate is determined by broker house. They don't have to follow anything. If the broker happy want to increase, it's up to them. Okay, then you cannot argue, and it's determined by the broker house. And yes, throughout history, sometimes it can be quite irrational to us. Does the broker from the no, it doesn't impact on credit score. Okay, but this is based on what my broker say. Okay, Arvin, answer to your question. It doesn't affect, but this is based on what my broker say. So of course, I'm lucky enough, I no need to test that out. Okay, but my broker said that it doesn't affect. How long is the loan tenure? Got age limit? No. There's no such concept of loan tenure. There's actually no age limit. Okay, but then as for what you highlighted, okay, your REITs is their credential. What you call that? Their mortgage. Basically, they are holding on to your REITs. Okay, you have the collateral with them. So this is the collateral. Your REITs is their collateral. Okay. Okay, Gloria. Yes, I'll come to that very soon. Okay, Gloria, I'll come to that very soon. Yes, I only now talk about nice things. Yes, I will talk about all the ugly things very soon. Just give me a minute. Okay, trust me, I will definitely give you a very balanced view. Answer to ML, yes, they're not working also can borrow. Okay, like I said, you are using collateral. Okay, they are willing to lend to you not because of you, but because of this collateral. They're actually basing this. So nothing to do with your credit rating, so on and so forth. Okay, all your REITs, they're actually holding on, in fact, in their name. Okay, good. Thanks for the questions. Now, just paint one more picture, to get you excited. Okay, but then again, of course, this is a lot of assumptions. And yes, trust me, later I'll talk about all the bad things. So let's say now you have a fully paid HDB condo worth 600,000. You go and upgrade to a condo 1 million. Okay, you loan 700,000 and free up 30,000 cash. Okay, what happened here is this: you got fully paid. You go and upgrade a condo 1 million. So to buy the condo 1 million, you only need to put in 300,000. Then you have this 300,000 cash. Okay, with this 300,000, you go and create a 1.05 million REITs portfolio of cash. Like I said, you can actually buy up to 3.5 times. So 1.5. So assume the asset increased by 3% per annum. Okay, so this is what happened. So this is the concept of sell one, buy two. I sell HDB, I upgrade condo, rest of money, okay, I buy a second property in terms of REITs. So let's say this is what happened. Let's say HDB 600,000 today, and assuming that price increased by 3% per annum, 25 years later, your HDB will be worth 1.3 million. Of course, there's no loan. You didn't borrow anything. So you have 1.3 million. But let's say, for example, you go and upgrade to a condo, 1 million. Okay. And then after that, you go and use the other one to go and buy a 1 million REITs portfolio. Okay. 25 years later, your condo, assuming that price increase of 3% per annum, will actually become 2.1 million. Your REITs portfolio will actually become 2.2 million. Okay. So this is what happened here. So as I mentioned just now, if you actually use REITs, right? Okay. The dividend from REITs, okay, basically is good enough to cover, okay, the installment for this condo and the interest component for the REITs. Okay, so I've done my mathematics. So basically, based on the dividend yield, which I believe I use 6%, 6% dividend yield, okay, it can actually cover the installment for your condo and at the same time pay off the interest rate. Okay, then of course you still have the loan of 700,000. Okay, so if let's say, for example, 25 years later, you go and sell away your REITs, you get 1.5 million here, your 2.1 million condo fully paid. If you actually done this, you become 3.6 million. Of course, this is a very nice picture. I'll talk about all the risks later. Okay, I'll talk about all the risks later. Okay, but then the point I want to stress across here is this. Okay, you can do a sell one, buy two strategy without exactly buying the second property. That's what I'm trying to say here. Okay, if you get my point, again, don't mind trouble you how many type of one. If you're not too sure of any calculation, can't see any number, please help me type a 0 or ask a question. Okay, so hopefully you all get the main point. If end of the day your second property is about making money, okay, you don't have to always really buy a second property. You can actually also do this. Okay, this has a pros, as you can see here. Now I talk about all the cons. Okay, I'm talking about all the bad part now. Okay, margin call. Okay, there's actually this thing called the margin call for REITs. Margin call. Okay, to talk about this margin call, I have to explain to you what is this thing called the margin ratio. What is this thing called the margin ratio? Margin ratio is the total stock value divided by the borrowed amount. Okay, so maybe you all can help me here. So let's say, for example, I put in $10,000. I borrowed 25,000, correct? Okay, I put in 10,000, I borrowed 25,000. In total, I buy $35,000 worth of REITs. So what is my margin ratio? Okay, can you all please help me calculate? So this is the question here. I put in 10,000. I borrow 25,000 and I buy a total of 35,000 worth of stocks. So total stock value is 35, borrow amount is 25. What is my margin ratio in this case? Can I just trouble someone to help to time the chat, please? What is my margin ratio in this case? Can someone please help me to Okay, thank you so much. It's 140, 140%. If you 35,000 here, divide by 25,000, okay, it's 140%. Okay. Okay. Okay, now here's the thing about margin call. If let's say your margin ratio drop below 140%, you will literally get a call from a broker and say, please top up. So it's called a margin call. You have to top up back to margin ratio of 1.4. Okay. If let's say, for example, the margin ratio drop below 130%, the broker can actually force sell on your behalf to pay off the borrowed amount. Okay, I have a numerical example here. Put 10,000, borrow 25 to buy 35. Margin ratio 140%. So of course, you all know that the REITs price, it fluctuates. So let's say the price actually dropped to 30,000. Okay, so your margin ratio become 30 divided by 25, so equal 120% margin call. Okay, so now here's the thing. When you actually do a margin call, that means you pay money. After you pay money, which one change? Your borrowing amount change or your stock value change? Okay, here's the question. So margin call means you have to top up to pay money. Okay, when you pay money, which of this variable change? Is it the borrow amount or is it the stock value? Thank you so much. It's the borrow amount change. Your borrow amount will reduce. Then of course, this one will go back up to 140% and above. Okay, so this is the risk, and you can see it can be quite easy to hit margin call. All you need to have is drop by 20%. Or in fact, 10+%, you will hit margin call already. Okay, so this is the downside of the margin on REITs. Okay, so how do we manage margin call risk? So number one, diversification is key. So when fully invested, we are looking at about 15 to 20 REITs invested at different timing. Okay, so diversification is we invest in different stock at different time. Must be different REITs. You don't want to buy on REITs like tomorrow declare bankrupt, then that's it already, you're gone. Okay, it can happen. It can happen. So in fact, last year we had one particular REIT now still suspended. Basically, if you're invested in that, can kiss your money goodbye already. Okay, so you need to diversify into different REITs, and you actually buy the REITs at different time. So that you won't have that kind of very huge price change. Okay, that's the point I'm trying to get at. So like, for example, if let's say, for example, you have 90,000, assuming you have 90,000, today you put in 19,000, then tomorrow go and buy 270,000 worth of REITs. So you can see it's actually very risky, very easy to get margin call. Can you see? The margin ratio is actually very close. So once the price fluctuates, then hit margin call already. So what I'm suggesting is this. If let's say you got 90,000, okay, be prepared to spread the money over 5 years. So break up the money into 3 portions. Okay, in this case, you will always have a buffer funds. Why 5 years? Is because usually about 5 year one cycle, 5 year one cycle, so that you will probably won't hit, or either that you have enough money to tide through that cycle. You only buy when there's enough spread. Dividend yield minus interest is more than 2%. Okay. Okay, what's the spread? You take the dividend minus the interest more than 2%. Then you reinvest the dividend to pay down the loan. You don't go and take out the dividend so that you create new buffer funds. And please take note, you still can, after you do all this, things still can go back. Then you still have to prepare to cut loss. Okay? So like, for example, if you really want to do this, okay, like I said, today, I'm just giving you an idea. What I've shared so far is definitely not enough for you to practice this. Okay, if you're interested, of course, you can start finding more about a margin account. Go and talk to your broker about margin account. Okay, of course, I currently don't have a course about margin on REITs, but if there's enough demand, I'm happy to run one. But my point is, okay, this one has its risk. Okay, long story short, this one is considered high risk. Okay, margin on REITs is actually considered high risk. Okay, let's not kid ourselves. It's actually considered high risk. So please know what you are doing. Please know how to control risk. I'm not here encouraging you to do it. I'm just saying that this is one option besides second property. So you can see here, if you actually spread out your funds, okay, if you do this, you spread out your funds, like let's say you got 90,000. Every month, I just buy 5,000, 5,000, 5,000, 5,000. So of course, the first 5 months is my own money. I'm not borrowing anything. So my borrow cost is 0. Obviously, my margin ratio is 0. Then after I put in my 30,000, then I start borrow money. Okay, I use borrowed money to buy for another 60,000. Then of course, with borrowed money, then my margin ratio will drop. And once 30 hit up to 90 already, right, then I have my buffer fund months. I put the other 30,000. Okay, so long story short, if got 90,000, I will spread it out like what I do here. Okay, I won't put the money in today, buy all the REITs today. No, I will buy monthly. In fact, I will buy over 5 years, so that my margin ratio will be a lot higher. Okay, I saw some question. Can we use margin to buy REITs ETF? Answer is yes. Okay, answer is yes, but it actually depends on your broker. Okay, of course, for those interested, you can check out this website. By the way, I'm not getting any commission from them. It's just that I use them. Okay, they may not give the best rate. Okay, I'm just familiar with this because I'm using it. So if you're interested, you can just go and look for a broker there. Okay, let's say for example, okay, you can actually check here. I think it's Lion Philip. Lion Philip. Okay, now here's the thing. Not all securities you actually can borrow at 2.8%. Okay, for like example, REITs ETF, if you want to buy can, you have to borrow at 4.5%. Okay, not 2.8 but 4.5. But let's say for example, STI ETF. Okay, you can borrow at 2.8. Okay, if I'm not wrong, all Singapore denominated REITs, all can be 2.5%, all can be 2.8%. Okay, like for example, all Singapore REITs, Singapore denominated, Keppel REIT. Okay, 2.8%. But if it's in US dollar, Keppel Pacific, like for example, US dollar, you can see it's actually 3.1%. Okay, please take note, different securities have different interests. So for REIT ETF, yes, you can, but you're borrowing at 4. Just now we saw it's 4.2 or 4.5. 4.5, I think. Okay, 4.5%. Something to take note. Okay, if prefer capital appreciation, go for REITs or real property. Okay, I may not have enough data to support. Okay, but generally speaking, I think it's about the same, because end of the day, the underlying assets is the same. It's just that one is residential property, one is commercial property. Okay, so REITs price also have have also appreciated quite a bit. Okay, so it's actually quite the same. It's actually quite the same. Also, answer to Preston question. Okay, last part on additional risk. Also, please take note, financing risk, make sure there's cash flow to pay interest. Interest rate can increase. Interest rate can increase. then of course market risk, price can decrease, the loss is magnified too. Okay, so that's all I want to talk about margin on REITs. Just give you some idea to explore further, not enough for you to implement. If you really wish to learn more, talk to a broker, or if let's say I have a further margin REIT course, okay, you may actually want to attend that. Okay, if not today, I just want to give you an idea. Besides buying a second property, you can actually do things on margin on REITs, which is what I do lah. Okay, I see my margin on REITs as my second property lah, because it works exactly the same. Okay, any last questions on margin on REITs? Okay, if not for the last 30 minutes, I just share with you again another buffet of different property investment strategies. Some of the property strategies we come across. And of course, just to give you idea. Now, one is upgrade without using cash income. Okay, I'm quite sure most of you have seen this already. Okay, anyway, I just run through very quickly. I've done this during preview. So Mr. and Mrs. Tan, they have money combined income 12,000, 4-room HDB flat fully paid, nearly 1 million for retirement. Okay, so let's say when they actually upgrade to a 1.2 million property, they only need to deposit 25%, which is 30,000. They release cash of 30,000. Sorry, 300,000. Sorry, yeah. Friday effect. Okay, apologize. Okay, deposit 25%, 300,000. Release cash of 300,000. Okay, and if let's say, for example, this $300,000 multiplied by 6%, assuming they're going to invest in things like REITs. Okay. This 3,000, theoretically speaking, can generate about 1,500 per month. Mortgage payment of 4,000. Okay, remaining 2,500 from CPF. So technically speaking, they do not use their cash income, okay, to service their mortgage, even with the upgrade. So of course, I mean, if you want to argue, a lot of things can go wrong, can really get 6% or not. Mortgage payment can increase or not. Okay, of course, all these can. But our point here is this: if you don't plan, it can never happen. If you plan, okay, there is a chance that it can happen. Okay, that's our main point. Compared to someone, I don't care lah. After I upgrade this 300,000, go and renovate lah. Then of course, it's a very different story altogether lah. Okay, can this be achieved? We don't know. But if you don't plan, definitely cannot achieve. Okay, now this one you probably have seen before. I just want to show you something extra. Okay, sorry, I think I can off this already. Yeah, of course, I will send you all the spreadsheets. Okay, I just want to share something. Potentially, it can be done. Is it definite? No. But if you plan, maybe there's a chance. Okay, same situation. Let's say this couple, you have a 600,000 HDB fully paid. Current saving 200,000. Go and buy a new property, 1.2 million, upgrade. Okay, minimum upfront is 335, as you can see here. Minimum upfront 335. I will send you all the Excel spreadsheet. You all can read the details. Then after that, take a $900,000 loan. Okay, monthly payment is 4,000 based on 2.5% interest at 25-year period. Monthly payment is 4,000. So this is what happened. They have practically 800,000 here. So after upgrading, after paying off this upfront payment, they actually have cash of about 464. Now, this is what happened here. If let's say, for example, they are very disciplined, okay, they are very clear what they want to do. So they don't go and touch this 464. At the same time, they actually go and invest this one for 6%. Plus, okay, every month, this 4,000 pay from their cash income. Okay, pay for their cash income. Okay, this 464 don't touch. Okay, 4,000 pay for cash income. And if let's say they can save another 2,000 every month, and this 2,000, same thing, go and invest, can get 6%. Okay, what we are trying to say here is this, after 6 years, okay, after about 6 years, the money here, 464, which is after upgrade what they have, every month save about 2,000, okay, invested at 6%. After about 6 years, it will become 807,510. Now, what is so unique about this number? So once it hit about 807,510, and if this amount of money, okay, generate 6% return, okay, it's just enough to, just nice to cover this $4,000. That's what I'm trying to say here. Okay, I repeat. So let's say after upgrade, we got 464. And okay, you try to save $2,000 after loan payment. Okay, this amount of money, go and invest, and assuming that you can achieve a return of 6%, after 6 years, your money will grow to become 807,510. Okay, and if let's say, for example, this money can generate 6% return, 6% return, okay, the amount of the dividend is actually can cover your monthly payment. Which means to say, with proper planning, after 6 years, your property is technically fully paid because you're not using cash income, you're actually using your investment income to actually pay for your monthly mortgage. Can you see? Okay, you are using your investment income to pay for your monthly mortgage. Okay, so once you hit 807, I can do a very quick calculation. Is equal, let's say, for example, this one, multiply by 6%, then you divide by 12. Okay, 4037. Just nice, 6% of this one can cover. And that means, technically speaking, you have sort of like fully paid your property because you're not using your cash income. Okay, if you understand what I'm trying to get at, don't mind just help me type a 1 into the chat, please. If you don't understand, maybe put a 0 or ask me questions. Okay, thank you so much. Okay, so again, my point here is this. A lot of assumptions. Yeah lah, y'all can argue. Wow, okay, your interest don't change, man. Okay, your interest don't change, man. You sure can get 6%? Yeah, of course. But my point here is this: if you plan, okay, there's a good chance that this one can be achieved lah. Okay, if you plan, this one can be achieved. But if you don't, you just don't care lah, let the money grow, then you never achieve lah. So it's possible, hopefully give you some ideas. Okay, one good strategy. A lot of times, don't just focus on, wow, I have to, after I upgrade, I have a $900,000 loan, $1 million loan. Don't even dare to quote my boss. No. So you can see both ways. One way is, if I use CPF, I'm not using cash income. The other way is, if proper planning, actually just after 6 years, I technically fully paid my property. So it's not so stressful. So one way to look at things. Okay, so this is, I will actually give you the Excel spreadsheet to you. Now, the other thing we actually want to highlight here is this. There are actually 4 ways to make money from property investment. 4 ways to make money from property investment. Okay, we all know what is capital gain, rental yield, quite straightforward. What a lot of people didn't actually see is this: property is actually very good for leverage. And property is actually very good for this thing called forced saving mechanism. In fact, a lot of people make money from property, more from these two, leverage and forced saving, rather than capital gain and rental yield. Okay, you think about it, capital gain. Okay, I buy stocks, my capital gain can be higher. Correct or not? Rental yield, I buy REITs, okay, my dividend yield can be higher. So what's the big deal? So in fact, a lot of people make money from leverage and forced saving mechanism. So my point here is this: we want to understand these two things here and really know how to fully utilize it when we do our property investment. Let's talk about leverage first. Let me explain what leverage is. Okay, let's go to an example. Let's say, for example, you buy a property $1 million. $1 million. Buy a property 1 million, and assuming rental yield is 3%. Okay, so rental you receive every year is equal to this multiplied by this 30,000. Okay, straightforward. Rental yield 3%, rental is 30,000. Now, if let's say, for example, instead of paying 1 million cash, you actually borrow, today you can actually borrow 75,000. So you only put in 250,000. Okay, instead of putting $1 million cash, you put in 250,000. You borrow, okay, this is your money, your equity. You actually loan 750,000. Okay. Your rental is actually still going to be 30,000. Rental is going to be 30,000. Okay, but your interest, of course, you have to pay interest. Okay, let's say current interest rate about 1.2%. So you have to pay an interest of equal to multiply by 750, 9,000, and net. Okay, net, you actually get 30 minus 9,000. Okay, 21,000. Okay, so in this case, what is your yield, or what we call leverage yield, or other than ROI, is actually equal to what? Okay, equal to 21,000 divide by what? Divide by 1 million or divide by 250K. Can I just troublesome to type on the chat? To find my leverage yield, or ROI, do I take 21,000 divide by 1 million or 250? Can I trouble someone to type on the chat, please? Or have I lost you already? Thank you so much. 250. I divide by 250. Okay. And your yield is, can you see? 8.4%. This is what leverage is. But of course, you can say that, yeah, I haven't include all the costs, whatever. So even though 8.4, maybe got 6-7%. If you calculate precisely, it's about 6%. Okay, so this is what leverage has done. Okay, so a lot of people thought rental yield is only 3%. No, in fact, most people are getting about 6-7% because of leveraging. Another thing you can see here is this. So let's say, for example, I buy $1 million property. I buy $1 million property. After that, I sold at 1.2 million, for example. Okay, so what's my return? My return is actually equal to this one minus this one. Okay, 1.2 minus 1 million divided by 1 million. Okay, 20% return. But same thing, let's say I borrow money, I only actually put in 250,000. When I buy it, I put in 250,000. And for simplicity, let's say, for example, it's an interest-only loan. Interest-only loan. Okay. And let's assume, okay. So I simplify the calculation a bit. Also later, I will refactor back. I put in $250,000. And assuming I actually, on the day, so let's assume that I still have 750,000 loan. Okay, so I put in 250,000. Okay, I buy $1 million property. I sold for 1.2. So after I sell, I have to pay off this 750,000 loan. So I take 1.2 minus 750,000. Okay, I actually get equal to this minus this. I actually get back 450,000. I put in 250, I get back 450. What is my return here? Okay, so it's actually equal to 450 minus 250 divided by 250. So can you see my return is actually 80%. That is the power of leveraging. So understand this. And that's why, for property investment, you always have to deal with loan. If you actually don't borrow money, you are not maximizing, especially if you have the objective of wealth accumulation. So this is about leveraging. Okay, understand this. Okay, of course, try to use it to your fullest on a risk-adjusted manner. So end of the day, borrowing is a double-edged sword. Interest rate can increase. Then, of course, you have a problem. So make sure you know how to manage the risk. Okay. Okay, the other one we actually want to talk about is actually this thing called the forced saving mechanism. As I mentioned, a lot of people get rich from property, not so much on capital gain, not so much on rental yield, but a forced saving mechanism. Okay, so again, let me show you the calculation on Excel. It's easier that way. Okay, so this is the part that your financial consultant will actually show you. You borrow 900,000 for 30 years, and let's assume that interest rate is 3.5%. Every month you have to pay 4041. Okay, this is your installment. Okay, what your financial consultant won't show you is actually this table. Okay, what is this table? You actually break down how your installment work to pay off the loan. Okay, so you may want to try and follow me. So let's say, for example, month 1, at the beginning of month 1, you actually owe the bank $900,000. Okay, you pay off 4041. Actually, out of this 4041, 2625 is to pay the interest. You actually pay 1416 to pay down the principal. Okay, basically this amount is not expense. So this one is giveaway. 2625 years I give to the bank. This one is not giving it away to bank. This one you're actually saving in your property. You actually pay down your property loan, or you can tell it this way, you're actually saving to a property. Okay, because why? Can you see end of month 1, you actually owe lesser money already. Can you see? And the process continue. So basically, you can see that as you proceed along, how much you save in your property actually increases. So on average, okay, averagely speaking, you actually pay 4,000 installment, right? 2,000 actually pay interest. Okay, But $2,000 is actually to save. You're actually saving money. You actually build out a system to save. So one way to help you to clarify is this. Let's say, for example, you actually paid for 5 years, which is 60 months. You no longer owe 900,000. You actually only owe 800,000. Basically, after 5 years, you have saved $100,000 into this property. So this is what we call a forced saving mechanism. Okay, think about this. On your own, is it easy to say that, okay, every month I set aside 2,000 a month, don't touch? Okay, maybe for 1 year can, but end of the year, suddenly you say that, if I don't watch the Northern Lights this year, then don't have any. Wow, that Mercedes new model, don't buy, don't have. Whatever say, gone. But for property, you cannot. Your money is actually locked in already. Okay, can you see that? So actually, it's that forced saving mechanism that actually help people to accumulate wealth. So understand this. Understand how property help you to really build out your wealth. Okay, especially for those who actually want this as a wealth accumulation. Use property as a wealth accumulation. So in that sense, like for example, retirement planning. A lot of people, when they actually buy property, they don't think about buying a bigger property. You realize or not? Okay, but then you think about this, you think about in terms of leverage, you think in terms of forced saving. Okay, if you can, when you upgrade and buy a bigger property, then 25 years later, when you retire, you just go and downgrade back. You don't need so big anyway, downgrade back. But because of the forced savings and the leverage effect, you are able to, generate a lot more cash. So hopefully you all understand what I'm trying to get at. So number one, understand how property make money, not just on capital gain, on rental yield. It's also on leverage and forced saving mechanism. So how do you actually fully utilize this? Of course, leverage is you borrow as much as possible on a risk-adjusted basis. Okay, I'm not saying there's no risk. Yes, there's risk in borrowing. Okay, also know how to manage your risk. Okay, on a leverage basis, and it's also a forced saving mechanism. So it eventually makes sense for you to buy something bigger. Okay, so that you save more money, and eventually when you need the money, where am I? Okay, when you need the money to retire, then you can actually downgrade back. Okay, hopefully you all know what I'm trying to get at. Okay, sorry, I'm a bit rushing here, so I know some of you actually really need to go at 10. So I try to finish everything by 10 o'clock. Then for those who need to go, can go. And of course, those who have questions, you can stay back. So I just want to run through again. Like I said, I want to give you all different ideas. And you see what is interesting. Then when you implement, you can talk to either John or Ken. Okay, the other strategy that we actually want to share is actually this thing called planning for multiple property ownership. I just again want to show in the Excel example. Okay, a lot of people may heard that Zunbo really can or not sell one HDB to become a multiple property owner. Is it guaranteed? No. But with planning, is it possible? Yes. That's what we are saying here. If you plan, there is a chance that you can do it. But if you don't plan, definitely cannot happen. So from numbers, I'm actually going to prove to you that it's actually very possible from one HDB to become a property owner. So let's say 600 HDB fully paid, current savings 50,000. Upgrade first property. Upfront 335. So your loan 900, okay? Then monthly payment 4,000. So first property, no problem. My 600,000, okay? I only need to pay 335. I got 65, so no problem. Okay, I can even afford a second property. Why? Because 650 minus 335, I still got spare. Okay, this amount of money I can actually use to pay the down payment for my second property. Of course, a smaller one. Enough. Okay. So in fact, total cash after upgrade, I left about 64,000, as you can see here. But don't forget, I would actually have rental income. And if let's say you want to plan for your third property, okay, you want to plan for a third property, this is what you may have to do. Okay, your loans are property from both loans, you actually pay from your cash income. Okay, that means husband maybe pay one of this mortgage, wife pay on this mortgage. Your rental of the second property don't touch. Let the rental income roll. Okay, and assuming that this money can grow by 6%, your 2 years later, this amount of money can grow to 128,000. 128,000. So with this amount, it's actually good enough to go and buy overseas property. Why overseas going to pay ABSD? Then of course, if you want to see margin on REITs as a third property, of course you can do that. So if let's say you want a physical property, you can go overseas. So like I said, as I mentioned, I actually went Bangkok, 200,000 can find you a very good property already. You can only borrow 50% there. Interest rate is 5%. Okay. Loan period is 15 years. Rental yield is about 5%. That is the numbers that I actually picked up when I was there. So upfront 100,000 you have. Okay, you actually have it here. Rental per month is actually 833. Rental yield 5%, multiply by this, divided by 12. Okay, your loan amount is actually 100,000. And then your mortgage per month is 791. So basically, the point I want to point out is this: your rental can cover the mortgage. So for your backup property, you put in $100,000. That's it. Don't care already. Your rental can cover your mortgage. So basically, you have created an auto wealth accumulation system. As 15 years later, your $100,000 becomes 200,000. Even not considering capital gain. Then to consider capital gain, your 100,000 after 15 years in this Bangkok one will become $200,000. Okay, in that sense, your one HDB can convert into 3 properties. Okay, I know by now you're all very tired. They look at so many numbers. So not to worry, this is recorded. You are going to have the Excel spreadsheet. You all go there and play. And of course, again, after that, if let's say this is something you want to implement, you can actually talk to John or Ken, and hopefully they can help you do so. Okay. If you still have some memory space, just remember this statement: HDB to 3 property. Possible, of course. Definite, no. Okay. Plan, maybe got chance. Don't plan, no chance. That's what we're trying to say here. So we just want to plant you some ideas. What are some of the property strategies you can do? Okay, I think there is 2 more things I want to talk about. Then we'll call it a day. Yeah, sorry, I think overshot. Maybe I end everything at 10:05. Okay, this is quite interesting. This is quite a recent case. Hopefully we can get some discussion here. A lot of people buy properties. They say that, I need to have own needs also. I need to stay near parents. At the same time, I also want investment. So how? So this is very recent case. And we got a very good solution for this. See, maybe you all can guess. So let's say, for example, you need to stay near your parents in Sembawang. And based on, okay, sorry, I don't know whether any of us stay in Sembawang, but based on my professional opinion, okay, I wouldn't say that Sembawang no growth, but relatively speaking, there are a lot of other places have better growth potential. So let's say, for example, you believe that Jurong has better growth potential, but you want to stay near your parents near Sembawang. So what can you do? Can I just get you all to try to think and see what the solution? So basically, you need to buy a house. You need to stay somewhere near your parents. At the same time, you hope that your property can appreciate. Okay, but you think that the property that I buy near my house won't appreciate. So how? Okay, thank you so much. Thank you so much. Okay, have you considered rental or not? You can actually do this called rental. So in fact, it's actually a very common strategy. So what people can do is, I just buy in Jurong, okay, and probably the rental can help I buy in Jurong to rent out. The rental could actually help to cover my Sembawang property. Okay. Yeah, correct. So I just correct. I just buy in Jurong. Of course, I have to pay for the mortgage. Then the rental in Jurong, I use the rental pick in to actually rent the property in Sembawang. Okay, so these are again some strategies for you to consider lah. Of course, when you have a specific case, you can't talk to us, or we can give you ideas. Again, buying property is don't have to be so dead whereby Sembawang there's no choice how to buy there. No, there's a lot of flexibility. Okay, well, good timing. Okay, the last thing I want to talk about is actually this thing called the equity loan play. Okay, why it actually makes sense. This is one of the benefits for staying in a private property lah. Okay, HDB has their own benefits. Private property has their own. Okay, this is one benefit that a lot of people didn't pay attention to, which is quite interesting. Of course, maybe John later can help me to add on a bit more about this. Okay, anyway, I just show you the mathematics first. So let's say you actually buy a property, 1.2 million. Okay, you already buy for 5 years. Let's say this is private property. And now your loan amount is about 60%. Okay, 60%. That means you actually owe about $720,000. Okay, so let's say 5 years ago you bought this property, and of course along the way you have been paying down, paying down, and assuming now you only own about 60% of the property, which is $720,000. Okay, so assuming that your property, the valuation increase, okay, property valuation increase. Let's assume that your property valuation go up to become 1.5 million. Okay, so like I said, this was 5 years ago. Okay, this is today. Your property become 1.4 million. Okay, you can think of it this way. Basically, I can take my property to go to a bank, and the bank said, oh, okay, now your property is worth 1.5 million, and I'm allowed to lend you 75%. Of course, okay, bearing all the TDSR and so on and so forth. So let's assume don't have TDSR problems and so forth. The bank can say, I can actually lend you 75%, which means the bank can actually lend you $1.125 million. Okay, 1.125 million. And okay, you can use this one to pay off your current loan, 720. Okay, and you actually can generate cash of 405,000. Okay, 405,000. Okay, so of course with this amount of money, let's say you need the money, like for example to finance your daughter's education or kids' education, or you can even, like for example, use this money to go and buy a second property. Basically, our point here is this: you are able to generate cash. You are able to generate cash from your current property. Okay, of course, at the expense of higher loan, So let's say you don't have the need for money. Okay, you think about this. So for your loan, you only pay about let's say 1.2%, at least currently 1.2%. Let's say this one, I just go and invest about 3%. I take this money, go and invest about 3%. Okay, let's say in bonds or something very safe, 3%. So basically what's going to happen here, I'm actually borrowing 405 at 1.2%. And I invest at 3%. I actually make a spread of 1.8%. So every year, I make an extra money of multiplied by 1.8. Okay, 7,000 over dollars. Not too shabby lah, not too shabby. Okay, so this is what we call equity loan play lah. And of course, you can only do this when you use a private property or on the assumption that your property valuation increase. Okay, so again, I just have to demonstrate to you, your private property is not just stay there, that's it, not just for retirement. There's also a lot of things you can actually do in between. John, you got anything to add about this point? I think there's some details I left out.
Okay, you mean you want me to touch on the CPF portion?
Yes, please, yeah.
Okay, so basically for equity loan to work, right, you shouldn't also use too much CPF, because how the bank sees is that when he lends money to you, he must have margin of safety. That's why whenever you take a loan today, right, usually the first loan is up to 75% of the property price. So the bank got the 25% margin if anything goes wrong. Okay, so let's say in the event now, let's say I use a lot of CPF for my property. So you know that this is what happened. If the bank need to force sell the house for any reasons, they need to, number one, be able to clear that room. Number two, they must also be able to pay back your CPF. So in the calculation, whatever equity you can take out, right, you must minus off the loan that you have outstanding with them, and also minus off the CPF used. Okay, so of course, there's a lot of argument out there saying should I or should I not use CPF? It will be another big argument. So if anyone interested to know about all this, maybe later we can discuss a little bit. But there's no hard and fast rule. Just remember on that. And second thing, must remember for equity loan, once you take out, if I'm not wrong, you can only use cash for the payment towards the loan. Okay, an equity loan is like a housing loan. It's back to your property, but just that the installment, right, has to be, that portion has to be in cash. You can just confirm whether I say it's correct. This is what I remember. Yeah.
Can you want to say anything?
Yep, correct. Yeah, I was thinking about the CPF part also. Yeah, that's great.
Okay. Thank you so much. So with that, I have actually covered all the strategies that I have installed for you. So maybe I just do a very quick recap of what are the things we have talked about today. Then of course, yes, it's 10 o'clock. For those who have questions, please feel free to stay back. For those who need to run, really thank you so much. So okay, once again, we actually at the start of the session, we talked about the different investment objective. Thank you so much for participating in exercise. Hopefully now it's clearer what you want to achieve, and when you come to property, what is most important to you, what are the things you can give out. Okay, then after that, we actually talk about some of the strategies to prevent paying ABSD, of course, a legal way. So I actually share with you the 6 different methods: decoupling, bigger units, dual key, overseas property, commercial property, margin on REITs. So it doesn't always mean that you have to buy a second property. And again, in my opinion, if you can avoid paying ABSD, please do so. There's no point paying. There's so many other ways for you to achieve the same objective at the same time not paying ABSD. Then we actually talk about some of the case studies of the different strategies. Okay, I've shared with you like how do you actually do upgrade without using cash income. So one is actually using the CPF. Okay, the other one is, of course, if you are disciplined enough, okay, build out the funds, then use the investment return to pay off. Okay, so it's actually possible that instead of paying 30 years, maybe you end up just pay for 6 years. Then your investment income is actually good enough to actually pay off your remaining mortgage. So we talk about this. Okay, we also highlight that property very good for leveraging, very good for forced saving mechanism. Okay, know how to use them in full. Okay, and that is very good for your retirement planning. Like for example, in fact, that's what a lot of people do now. If they can buy a bigger property. So instead, yes, I only need 2-bedroom, but buy a 3-bedroom. And because you buy a bigger property, you actually have a bigger forced saving engine. And that may actually help you to accumulate more funds in the future, and you can downgrade back to release the funds. Okay. End of the day, nobody say that you buy property cannot sell. A lot of people always think that, yeah, I borrow 1 million, I won't be. No what? If let's say after 5 years, you don't feel like paying the loan anymore, just sell. Okay, so that's another way to look at things. Then of course, we also talk about for those who are ambitious, want to do multiple property ownership, is possible. Definitely possible. From HDB to 3 properties, 4 properties is definitely possible. You just need to plan. But of course, definite, nobody dare to say definite, but it's possible. Okay, balancing between own needs and investment needs. There is a lot of different solutions. This is just one example. And lastly, we talk about equity loan play. Okay, so I think there's a huge spread of buffet. Hopefully today you all had your feel and you'll find this a very fulfilling experience. And of course, I think it's a bit overwhelming. But anyway, you can revisit the videos. You can talk to John, talk to Ken, and get the ideas from there.